All right, today we're diving into the latest financial report from Sitra Holdings. And honestly, at first glance, the numbers tell a really confusing story. You've got sales that are absolutely booming, but at the same time, their losses are actually getting bigger. So we're going to dig in and figure out what's really going on with this company, because it looks like they're caught in a classic squeeze play. So here's how we're going to break it all down. First up, the big one, the bottom line. Did they make money or not? Then we'll look at the good news, the bright spot in their sales figures, before we get into the costs that are causing all this pressure. After a quick financial health check, we'll even look at a pretty surprising potential future for the company. So let's jump right in. Okay, so first things first, when you look at any company's report, what you really want to know is the bottom line. It just cuts through all the noise and tells you, at the end of the day, did they make a profit or did they have a loss? And well, there you have it. For fiscal year 2025, Sitra posted a loss of nearly 1.3 million Singapore dollars. And for anyone who might be new to looking at financial statements, those parentheses, that's just the universal accountant's way of saying it's a negative number. So step one is clear. The company is in the red. But, a single number by itself doesn't really tell you the whole story. The key here is the trend. When you compare it to last year, Citra's loss didn't get smaller, it actually grew by 11%. And that is the first real red flag for any investor. It makes you ask the question, what is going wrong here? But this is where the plot thickens. Because while that bottom line looks pretty bleak, the top line, which is the company's total sales, tells a completely different and actually a much more positive story. Just look at this. Citra's total sales, or what we call revenue, jumped by a really healthy 21%, going from $12.7 million up to $15.4 million. I mean, for any company, seeing your sales grow by more than a fifth in just 1 year, that's a big deal. It tells you that the market really wants what you're selling. So where's all this demand coming from? Well, it looks like the company is really focused on two key regions. Europe makes up more than half of their business, and then Australia and New Zealand bring in another 40%. This tells us their success is really tied to what's happening in these specific international markets. And this brings us right back to our central mystery. I mean, if you're selling way more stuff, if your revenue is growing this strongly, shouldn't you be making more money? Or at the very least, losing less? It's a paradox. And the answer? Well, it's on the other side of the accounting ledger. The answer to our little puzzle is right here. It's all about costs. See, profit isn't just about how much you sell. It's about how much of that money you actually get to keep. And to understand that, we have to look at what it costs Sitra to produce and sell its goods. So first, a real quick definition of cost of sales. It's just like the slide says. If you were running a lemonade stand, it would be the cost of your lemons, your sugar, and your water. For Sitra, it's the raw materials and the manufacturing costs. Everything that goes directly into the products they sell. And this slide right here illustrates the problem perfectly. While Citra's sales grew by a strong 21%, the cost to actually make their products grew even faster, at 24%. This is the squeeze we've been talking about. The costs are literally growing faster than the sales, and it's eating away at any potential profit. And the direct result of that squeeze, their gross profit, that's the money you have left right after you subtract production costs from your revenue, it actually fell by 5%. Think about that. Even though they sold millions more in products, their initial profit from all those sales was actually lower than it was the year before. Okay, so now let's zoom out a bit. A single year's profit or loss is really important, yeah? But as an investor, you also want to know about the company's overall financial stability. And for that, we have to look at a different part of the report, the balance sheet. We're going to look at a key metric called net assets. It's really just a simple way of thinking about a company's net worth. You take everything the company owns, all of its assets, and you subtract everything it owes, all of its liabilities. Whatever is left over is the net asset value. And the balance sheet, well, it confirms the trend we saw on the income statement. The company's net assets, its overall net worth, has gone down from $8.2 million to $6.9 million. To put it simply, the company's financial foundation got weaker over the last year. So, with a shrinking financial base and growing losses, what's the plan? Well, the report gives us a hint about a potential pivot, a move into a totally different industry that could, well, change everything about the company's future. So the company has an entire property development business that, as the report says, has generated zero revenue so far. Now, for an investor, this is a real double-edged sword. On one hand, it could be a future engine of growth that turns the whole company around. But on the other, it could be a very expensive distraction from fixing the problems they have in their main business. Right now, it's just a big question mark. Okay, let's pull all of these different threads together. What's the essential story of Citra's fiscal year 2025 from an investor's point of view? So the story is really one of a company in a tough spot. There's strong demand for their products, which is fantastic news. But that good news is being completely wiped out by problems with cost control. And that's led to a bigger loss and a weaker financial position. And then, hanging over all of it is this potential move into property development, a high-risk, high-reward bet that for now is still just an idea on paper. And with that, we'll wrap this up. Just a quick reminder, this content is intended to serve strictly and only as an informational, independent, objective summary of recent events and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.